Are you new to saving the money you earned working so hard? Or are you someone who has been struggling with saving your money? This video just might be what you are looking for. Welcome to Moneymaker. Moneymaker is a channel dedicated to helping others become financially independent, FIRE movement, through cryptocurrency trading and investing. Well, today we will be talking about protecting your money from deflation. We will be discussing 5 different ways to do it. Trust me, it would not disappoint you. But before we start, make sure to like, subscribe, and share. Press the bell icon to never miss a video from us, and we are together in building your portfolio. Let us dive right in without further ado. What is deflation? Deflation is a general decline in prices for goods and services, typically associated with a contraction in the supply of money and credit in the economy. During deflation, the purchasing power of currency rises over time. It is usually associated with a contraction in the supply of money and credit, but prices can also fall due to increased productivity and technological improvements. Whether the economy, price level, and money supply are deflating or inflating changes the appeal of different investment options. Deflation causes the nominal costs of capital, labor, goods, and services to fall, though their relative prices may be unchanged. Deflation has been a prevalent concern among economists for decades. On its face, deflation benefits consumers because they can purchase more goods and services with the same nominal income over time. However, not everyone wins from lower prices, and economists are often concerned about the consequences of falling prices on various sectors of the economy, especially in financial matters. In particular, deflation can harm borrowers who can be bound to pay their debts in money that is worth more than the money they borrowed, as well as any financial market participants who invest or speculate on the prospect of rising prices. There are many ways to protect your money from deflation. Let us look at them one by one. Owning rental properties. Even the idea of buying a home or apartment to rent out for profit may sound alluring, but purchasing a rental property for income and long-term capital appreciation can have its ups and downs. To give an example, the housing market can fluctuate depending on location, supply and demand, and the economy. Financially speaking, for the rental property to be profitable, the return you reap should be greater than what you could earn in conservative investments, such as bonds and dividend-paying blue-chip stocks, because of the real risks involved. And on the human side, not everyone can manage property and tenants. Let us have a look at the pros and cons of owning a rental property. Pros: provides regular income and properties can appreciate. Maximizes capital through leverage. Many tax-deductible associated expenses. Cons: it can be tedious managing tenants. Potentially damaged property from tenants. Reduced income from potential vacancies. According to the U.S. Census Bureau data, sales prices of new homes have consistently increased in value from 1940 to 2006, before dipping during the financial crisis. Consequently, sales prices resumed their ascent, even surpassing pre-crisis levels. It remains to be seen what the long-term effects of the coronavirus pandemic will be on real estate values.
Real estate, huh?
Rental properties can be financially rewarding while having numerous tax benefits, including the ability to deduct insurance, the interest on your mortgage, and maintenance costs. However, the drawbacks of having a rental property include a lack of liquidity, the cost of upkeep, the potential for difficult tenants. The neighborhood's appeal has declined. It's vital for investors in any type of real estate to stay on top of interest rates and consult a tax professional, particularly with the recent changes to the tax code. Next up, real estate investment groups, or REIGs. This is ideal for people who want to own real estate without the hassles of running it. Investing in real estate investment groups requires a capital cushion and access to financing. Real estate investment groups are like small mutual funds that invest in rental properties. A company buys or builds a set of apartment blocks or condos in a typical real estate investment group, allowing the investors to purchase them through the company, thereby joining the group. Here, a single investor can own one or multiple units of self-contained living space. But the company, which is operating the investment group, will collectively manage all of the teams, handling maintenance, advertising vacancies, and interviewing tenants. In exchange for conducting these management tasks, the company takes a monthly or annual rent percentage. In a typical real estate investment group, the lease is in the investor's name and all of the units pool a portion of the rent to guard against occasional vacancies. And you will receive some income even if your unit is empty, which is the highlight of the real estate investment groups. As long as the vacancy rate for the pooled units doesn't spike too high, there should be enough to cover costs. Pros: more hands-off than owning rentals, provides income and appreciation. Cons: vacancy risks, similar fees as mutual funds, susceptible to unscrupulous managers. Third, house flipping.
We're flipping a house!
House flipping is for people with significant experience in real estate valuation, marketing, and renovation. House flipping requires capital and the ability to do or oversee repairs as needed. This is the proverbial wild side of real estate investing. Just as day trading is different from buy and hold investors, real estate flippers are distinct from buy and rent landlords. Case in point, real estate flippers often look to profitably sell the undervalued properties they buy in less than 6 months. Pure property flippers continually don't invest in improving properties. Therefore, the investment must already have the intrinsic value needed to turn a profit without any alterations, or they'll eliminate the property from contention. Flippers who cannot swiftly unload a property may find themselves in trouble because they typically don't keep enough uncommitted cash on hand to pay the mortgage on a property over the long term. This can lead to continued snowballing losses. Another kind of flipper makes money by buying reasonably priced properties and adding value by renovating them. This can be a longer-term investment where investors can only afford to take on 1 or 2 properties at a time. There are a few pros and cons. Let us take a look at them. Pros: ties up capital for a shorter time period, can offer quick returns. Cons: requires a deeper market knowledge, hot markets cooling unexpectedly. Commodities. Commodities are a broad category that includes grain, precious metals, electricity, oil, beef, orange juice, natural gas, foreign currencies, emissions, and specific other financial instruments. Commodities and inflation have a unique relationship, where commodities are an indicator of inflation to come. As the price of a commodity rises, so does the cost of the products that the commodity is used to produce. Fortunately, it's possible to broadly invest in commodities via exchange-traded funds. The iShares S&P GSCI Commodity Indexed Trust is a commodity ETF worth considering. Gold is a commodity that is worth special mention. It has often been considered a hedge against inflation. Many people have looked to gold as an alternative currency, particularly in countries where the native currency loses value. These countries tend to utilize gold or other strong currencies when their own currency has failed. Gold is a real physical asset and tends to hold its value for the most part. Before investing in commodities, investors should be aware that they are highly volatile, and investor caution is advised in commodity trading. Because commodities are dependent on demand and supply factors, a slight change in supply due to geopolitical tensions or conflicts can adversely affect the prices of commodities. Finally, we have Bitcoin. Bitcoin is seen as an inflation hedge mainly because of its limited supply, which is not influenced by its price, and because of its relative attractiveness when real yields head to 0 or lower. Yet, when you buy Bitcoin, you're not just doing so to hedge inflation. You're buying Bitcoin to hedge all the other negative consequences that usually accompany it. Bitcoin is also a hedge for unstable governments that close bank accounts, police states that want to seize private wealth, broken payments rails due to corrupted systems or outside cyber attack threats, paranoid leaders that want to disenfranchise opponents, export-protecting devaluations that trigger more inflation. These are less likely in developed economies, but let's not forget that tipping points lurk around unexpected corners and that Venezuela was once one of the wealthiest countries in the world and one of the more stable democracies in Latin America. Bitcoin's supply will not decrease but will continue to increase until the block rewards run out sometime around 2140. At that point, Bitcoin will reach a hard cap of 21 million coins. Conclusion: whether real estate investors use their properties to generate rental income or bide their time until the perfect selling opportunity arises, building out a robust investment program is possible by paying a relatively small part of a property's total value upfront. And as with any investment, there is profit and potential within real estate, whether the overall market is up or down. The other methods we discussed to protect your money from deflation are also known to be tested and proven. We would suggest you invest bit by bit in all these options. It is always better not to put all the eggs in one basket because it is impossible to predict the ultimate security in any of these measures. Well, with that, we have come to the end of the video. I hope it was helpful. What do you think about these 5 ways to protect your money from inflation? Let me know in the comment section. Please like and subscribe before you leave. See you next time.